How to easily outperform financial advisors. So it's easy to outperform financial advisors. Why? Well, conventional wisdom is that that underperformance is because of fees, but there is an even bigger reason. So they don't even try to outperform. They try for reasonable returns with less risk. So financial advisors are mainly salespeople, not financial planners. They are more likely to lose a client because of a 30% one-year decline than 10 years of lagging the index. So they focus on market fluctuations, not your life goals. So this makes them do what I call the four performance drags that typically reduce their returns by at least 3% a year, which is more than their fees. So first they use bonds or fixed income. They try to force you to buy bonds, even though studies show that over 20-year periods, equities, stocks are more reliable. Stocks have a lower 20-year standard deviation after inflation than bonds. Stocks have historically provided a reliable 30-year retirement, withdrawing 4% a year of your investments, while bonds usually failed. They have a home country bias. They invest in Canada because it sounds safer, even though returns have been 1 to 3% lower than global stocks. Canada's index is not a diversified portfolio. It's a resource and financial sector fund. So, and they also do what I call is riding the brake. They have many ways to invest too conservatively for you to have the future that you want. So, and they do what I call like one idea investing, one idea, which is, for example, dividend investing or low volatility investing. They sound good, but, dividend investing is a brain fart. I got a video about that. So financial advisors all do a risk tolerance questionnaire. You've probably seen one of those. So you don't invest too aggressively. But few do financial planning so that you don't invest too conservatively to achieve your life goals. So it's easy to outperform financial advisors because they're short-term thinkers and not long-term total return investors. So just get the total return of the global US equity index and you outperform financial advisors. You could use one broad index ETF or invest with top fund managers that outperform. So we invest for actually above index returns, try to beat the index with an elite portfolio manager that finds the world's best investors that all have 15 to 30-year track records beating the index after all fees. Most fund managers lag, but just like any field, there are some amazing people that outperform. We try to beat the global equity index after all fees, including ours, so that our fee-for-service financial planning advice is purely value added. Don't invest for return with less risk. Invest for maximum reliable long-term total returns. So now details that if you want to see figures that support all this, details are in last week's full post on this topic on my blog, which is www.edrempel.com. It's the #1 blog in Canada for a financial planner. If you're interested in talking with us, just go to edrempel.com/talk. Thanks for listening, and we'll talk to you next week.